All right, guys, welcome back. In this video, we're going to talk about how to analyze a deal in investment for real estate investment. Now, we're not going to look at fix and flip because, again, that is more of a real estate business. So we're not going to cover that here. This is a regular buy and hold property with long-term lease in place, right? Long-term tenants. We're not doing short-term. That is slightly different. I'll just talk about the decisions to make there. But we're going to look at long-term. So how do you analyze a deal? How can you tell if something is good or not? Okay. Number one, you have to approach purchasing real estate as a business decision, okay? We don't need to be sentimental about this. It's all about the numbers. So we need to understand what price of home we are targeting, okay? How much capital do you have? Or how much have you and a partner, how much do you have together, right? What size of a mortgage could you qualify for if you're going that route, right? You got to figure out all those pieces and say, okay, well, I think I could qualify for this kind of mortgage and I could cash flow this much. And so that means, right, this price of home or property. Okay, so you have to have a good idea there of the price of home and also the type of home that you're targeting. Okay, and then you're going to want to understand the area and the demographics. You may invest in an area you know really well, like in your same town or in a surrounding area. But oftentimes, it doesn't make sense to invest in the area that you live, okay? And so it's very common to invest in areas outside of areas that you know well, right? I have a number of clients that invest out of the state that they live in, right? The state they live in, real estate is really expensive, and it's not altogether a great investment from a cash flow perspective. And so maybe for appreciation, but not for cash flow. So they've gone to other states and they found properties that do give the cash flow that they're looking for. And typically those properties end up being less in value overall. So it's very possible some might be a little bit uncomfortable investing in another state and maybe even investing in a property you've never seen before, but it is done commonly and you can do it for great success. Okay. So understand what the area, what the demographics are. Is this place that I'm investing in, are property values rising? Okay, is the inflation, is the population growing, right? Or is there net influx of people? Is the economy good? Is there a shortage of housing, right? Are there too many people for the amount of houses, right? Meaning that there's good demand. All of these different things, right? Are we near a university? Does that mean I'm going to be renting to a lot of students? Are we near to like a military base where there's going to be a lot of turnover, but long-term and, fairly long-term, a couple years worth of tenant lease where they might be assigned to a base and you rent to them long-term and they're good tenants and then they move and, right? All of these different factors you got to factor in. Okay. Think about where you want to be, what type of tenants you want to have, what kind of property you want to have, and then, of course, your price. And then we need to analyze the numbers. Once you kind of narrow down what you're looking for, start looking at the numbers. So you have to look at, number one, property purchase price. How much is the property? And what do you think you could get as far as monthly rental income? Right? So you can do this a number of ways. You can do your own research, right? You can pull up realtor.com, you can pull up Zillow, you can pull up any site that has homes for sale. And then you can also search in the same area for homes that are for rent. Okay. So you can, in one city, right, or one particular neighborhood, you can look at homes for sale and homes for rent in the same area. Find a comparable home, see what the rents are being charged, and boom, there you go. You've got it. Okay. So look at what the potential monthly rental income could be. All right. Then you have to factor in the costs. So down payment, if this is an investment property, you're gonna be putting down 20% plus maybe closing costs. Are you gonna need to do any repairs to the property, or is it ready to go? Is it turnkey and you can buy it and put renters right in? Or does it need a little bit of work, fresh coat of paint, new carpet, that type of thing, okay? Maybe it needs serious renovations. You gotta factor those costs in. Right? You need to factor in vacancies. You can't count on 100% rental income. Again, it depends on the renters, but if renters leave and it takes you a month or 2 or 3 months to fill that vacancy, those months are months where you're not receiving rental income. So you have to factor that in. So it's wise to always estimate something, maybe 75 or 85% occupancy rate meaning that 75 or 85% of the time it's being occupied. So something like maybe 2 or 3 months out of the year, maybe it's unoccupied. Okay, so you just kind of factor that in and say, hey, do I have the cash flow to support that? Okay, you're also going to want to set aside a reserve fund. And this would cover vacancies. It would also cover repairs. And you're going to want to have a decent fund. Sometimes when you are going to get a mortgage and qualify, they make sure that you have funds set aside. Say, hey, where's your reserve fund? Do you have funds set aside in case something goes wrong? Can you still pay the mortgage, right? So 3 to 6 months worth of expenses, you're going to want to set aside to cover during vacancy or for repairs and things like that. It's kind of like a little emergency fund, but it's just for the rental property. And then you look at the ongoing monthly costs. So let's look at the mortgage principal and interest, right? You can do all of this very easily. There's millions of mortgage calculators out there. Usually on those sites, they have mortgage calculators. So factor it in, right? If I put 20% down on this property, then what is estimate an interest rate? Again, if it's an investment property, it's going to be a little bit higher. If you're house hacking, it can be lower, but investment property is a little bit higher. What's my mortgage principal and interest payment per month? How much is homeowner's insurance? What is the property tax? And if you are going to do property management, typically that ranges between 8 to 10%, 8 to 12%. It's usually like 10% on average. So 8 to 12% of monthly rents collected that goes out to property management. So that kind of covers most of the numbers here. And what you're going to want to do with those is you're going to want to understand what are my total costs up front, and then what is my monthly cash flow look like? And then you're going to take your net cash flow to you and you're going to divide it by your upfront cost. And that is what's called your cash on cash return. All right. You want to understand what your cash on cash return is. It's a great way to analyze and decide between different properties and which would make more sense or not be a good fit for you. Okay. So in the next video, we're going to walk through an example, look at some numbers, and just talk through it. We'll see you guys in the next one.
Build income, not stress.